including representation, information, public relations, and business development. Welcome.
Chairman Velasquez and other members of the committee, thank you very much for the opportunity to testify at today's hearing on behalf of the Credit Union National Association, which represents over 90% of our nation's 8,000 state and federal credit unions, their state leagues, and their 92 million members. I'm Bill Hampel, CUNA's chief economist. Credit unions did not contribute to the recent financial debacle, and their current regulatory regime, coupled with their cooperative structure, militates against credit unions ever contributing to a financial crisis. As Congress considers regulatory restructuring, it is important that you not throw out the baby with the bathwater. Regulatory restructuring should not just mean more regulation. There needs to be recognition that in certain areas, such as credit unions, the regulation and enforcement is sound and that regulated entities are performing well. Credit unions have several concerns in the current regulatory restructuring debate. These include the preservation of an independent regulator, the development of the CFPA, and the restoration of credit unions' ability to serve their business-owning members. First, it is critical that Congress retain an independent credit union regulator. Because of credit unions' unique mission, governance, and ownership structure, they tend to operate in a low-risk, member-friendly manner. Applying bank-like regulatory system to this cooperative model would threaten the benefits the credit unions provide their members. There is some logic for consolidating bank regulators where competition can lead to lax regulation and supervision, but that condition does not exist for credit unions, which have only one federal regulator, the National Credit Union Administration. The general health of the credit union system proves that our system works well. Concerning the CFPA, consumers of financial products, especially those provided by currently unregulated entities, do need greater protection. CUNA agrees that a CFPA could be an effective way to achieve that protection, provided the agency does not impose redundant or unnecessary regulatory burdens on credit unions. In order for a CFPA to work, consumer protection regulation must be consolidated and streamlined to lower costs and improve consumer understanding. CUNA strongly feels that the CFPA should have full authority to write the rules for consumer protection, but for currently regulated entities, such as credit unions, the examination, supervision, and enforcement of those regulations should be performed by the prudential regulator, which understands their unique nature. Under this approach, the CFPA would have backup examination authority. CUNA urges Congresses to take the difficult step of preempting state consumer protection laws if establishing a CFPA. We are confident that by creating a powerful federal agency with responsibility to regulate consumer protection law with rigorous congressional oversight, more than adequate consumer protection will be achieved. And if the CFPA is sufficiently empowered to ensure nationwide consumer protection, why should any additional state rules be necessary? Conversely, if the proposed CFPA is not expected to be up to the task, why even bother establishing such an agency in the first place? Finally, because they are already significantly regulated at the state level, we don't believe that certain types of credit, life, and disability insurance should be under the CFPA. As Congress considers regulatory restructuring legislation, CUNA strongly urges Congress to restore credit unions' ability to properly serve the lending needs of their business-owning members. There is no economic or safety and soundness rationale to cap credit union business lending at 12.25% of assets. Before 1998, credit unions faced no statutory limit on their business lending. The only reason this restriction exists is because the banking lobby was able to leverage the provision when credit unions sought legislation to permit them to continue serving their members. The credit union business lending cap is overly restrictive and undermines America's small businesses. It severely limits the ability of credit unions to provide loans to small businesses at a time when these borrowers are finding it increasingly difficult to obtain credit from other types of financial institutions, as was described by Mr. Hirschman from the U.S. Chamber in the previous panel. It also discourages credit unions that would like to enter the business lending market from doing so. We are under no illusion that credit unions can be the complete solution to the credit crunch that small businesses face, but we are convinced that credit unions should be allowed to play a bigger part in the solution. Eliminating or expanding the business lending cap would allow more credit unions to generate the portfolios needed to comply with NCUA's regulatory requirements and would expand business loans to many credit union members, thus helping local communities and the economy. And credit unions would do this lending prudently. The loss rate on business loans at credit unions is substantially below that at commercial banks. A growing list of small business and public policy groups agree that now is the time to eliminate the statutory credit union business lending cap for credit unions. And in July, Representatives Kanjorski and Royce introduced H.R. 3380, the Promoting Lending to America's Small Business Act, which would increase the credit union business lending cap to 25% of total assets and change the size of a loan considered to be considered a business loan. We estimate that credit unions could, and safely and soundly, lend an additional $10 billion in small loans in the first year after enactment of such a bill. Madam Chairwoman, thank you very much for convening this hearing, and I look forward to answering the committee's questions.
Thank you. And we have 3 votes, so the committee will stand in recess and reconvene right after these votes.